you should have checked out the announcements in the announcements folder in the Blackboard. Okay, so let me just quickly so this is not all of this is what you can see, but let me first let me check out. This is today's forum where you should have signed in, and the last time I checked, maybe let me refresh it. Yeah, we have 5 people, right? It says 7, but 2 are my postings, my threads. So basically, we have 5 people here, and then we have, you see, we have 10 people, except myself. There are 9. So at least 4 of these people here haven't signed into today's forum. Okay, so that's the first thing. Please go, if you haven't yet, please go to the discussion board and sign into, do the attendance report. Okay, this is the sign-in sheet. This is the in the in-person class and face-to-face class. As you walk into the classroom, either the professor would do the roll call at some point, or there's a sign-in sheet where you sign in. This is the digital sign-in sheet, okay? And this is the physical proof of your attendance. So if you miss this, you won't have any physical proof of attendance. You cannot tell me, oh, I was there, professor. Where's the proof? Huh? Where's the proof? I mean, unless I take a screen grab of this every time. But this, although this session will be recorded, it is being recorded currently. But depending on the connectivity, right? Sometimes you are, sometimes some people get dropped out because they lost connection, or some people once they lose connection, and some come back, but some never come back. But the best way to now I have 9 people, right? And so the physical proof, right? That's very important, right? Without any physical proof, you can't tell me. Always put yourself in the situation when you have to verbally explain that you were there, or you did that, or you didn't do that. That's gonna make your life very difficult and complicated. So always, it falls upon you, right? It's your responsibility to make sure that you have the proof, right? You have the proof. So I have, it's 9, except myself here. So I believe almost everyone is in there. Good. Now, so let's also so far these are the I have only about 5 postings so far, right? And one important thing is most of you have checked out, right? Which email to use if you want to send email to me. But some people probably haven't, if you haven't noticed this. And then if this is your first class, go to course information and check out everything there. There's basically, syllabus and, how your attendance is counted as part of your semester grade, and also about the participation points. And you need Connect. Well, if you buy the textbook, the custom edition, it comes with the Connect. You will need Connect Connect access, and my office hours, right? So that's pretty much, and then last Thursday, it was just 1 hour, right? So it was this brief introduction. Um, Basically, I gave you a tour of the configuration of this uh, organization and configuration of this Blackboard course. And this is the folder that is visible to you now. Oh, there's only one folder that's visible to you, but everything is all pre-built in, right? And I'm looking at it through the student mode. So this is basically what you can see. And if you were here in last class, or if you missed it, and since you have access to this folder, right, you could have checked this out. You missed, August 26th class, then you should have checked this out. And then these two videos were assigned on August 26th. At these, there should be video part 5 is missing, but it's not missing. It's there. It's just not turned on. Where's part? Oh, where's part 5? Okay, no problem. I gotta do this. Just give me a few. So I told you in the last class that this is collaborate session is not the main lecture. The main lecture is delivered through these videos, right? It's delivered through these videos. So this is like the pre-assigned reading, right? You come to class after doing the pre-assigned reading. So it's just like that. You have to watch the videos, assigned videos, and because of the way it is, scheduled, because of the way the classes are scheduled, and you don't have access to Connect. You don't have access to a Blackboard before the semester started. Before the semester began, you had no access to Blackboard, so there was no way you could do pre-assigned reading. I mean, it's not reading, but I'm comparing it to pre-assigned reading, but it's actually pre-assigned watching, right, instead of reading. But the first day's video lectures, first day 1 lecture videos, you have no access to that prior to the day 1. So it just, it's inevitable that you will have to be, videos 1, 2, right? You are able to watch them over the weekend. And part 3 through part 6, this you couldn't watch ahead of, in advance, but that's fine. I mean, you'll be watching them from today, and we will then, in the collaborate session, we are basically reviewing and reflecting on the main lecture videos. So on this coming Thursday, we will be reflecting on video part 3, 4, 5, and 6. So I've been telling you, our collaborate session is not the main lecture. It's rather more like an afterglow. Okay, it's more like an afterglow or kind of review session where you reflect on this. And what, because of the limitation, I mean, there is inevitably uh, limitation in time in face-to-face class. We have only 3 hours. We meet only 3 hours per week, and one semester is 15 weeks. But effectively it's 14 weeks. Because there's Thanksgiving and but if there's no holidays, no Thanksgiving, nothing like that, it's supposed to be 15 weeks, because three credit a 3 credit course that must meet 3 hours per week for 15-week semester. So that's 45 contact hours. In a face-to-face class, there is no if we meet 45 hours and we have to cover everything in 45 hours, but then this course is not a pampering course. This is not a mushy soft course. This is a very hard course first to begin with, right? It's not only difficult, but the nature, the content and nature has no soft side on it, right? It's all mathematical. It's all I don't know if you can enjoy a math class or physics class. If you're the kind of person who can enjoy a math class or a physics class, this class is for you. Okay, you will swim like a fish in the water. But if you're kind of touchy-feely literature class type of person, you will have little hard time adjusting. It's not insurmountable, right? You can overcome. It's only a matter of mindset and training. You got to train yourself. Your mind should be like in a combat mode. It's like, oh, I'm not that kind of person. No, it's inevitable. The life is a battle anyway. Life is a combat. You have to be at least your mindset must be in a combat mode. You should be able to cope with any situation, right? And you have to mentally prepare yourself to be able to cope with any situation. So it's really hard. I mean, even from in terms of teaching, to meet all that. First of all, because the content is not easily people generally think class like English class or history class, all it takes is just reading. It doesn't take much of analytical thinking. Of course, good literature class requires a good literature requires a lot of analytical thinking, analytical reasoning. It's all analytical reasoning is all about why. Why is it like this here, and what connection does it have with that part? And all you must have that systematic thinking, so that you will be able to organize your own structure of mechanism to process that that information, or the stockpile of information contained in that class or in that lecture. But if you don't have that kind of structural systematic thinking, and you just have linear thinking, then it's not going to be easy. and it's not easy to teach it within 45 hours, right? Within 45 hours. So collaborate session is like doubling it up, because um, it is all lectures are delivered. Main lectures are delivered through the pre-recorded videos. They are made. They are 45 hours, right? They are literally like 45-hour, one semester, 15 weeks, right, of in-person class. But then the gaps, because those 45 hours are very intense and demanding 45 hours with hard materials, um, for people that need, um, there are people that need flesh, right? Not There are people that can that cannot process anything that is only in straightforward, um, um, uh, concise, terse language, or in concise and terse form. These There are people uh, that need verbiage, to flesh it out. And so 45 hours are not certainly not enough for those people. That's why in the collaborate session, I I use it um, I use it to have more, to add more flesh to the bare, bone and knuckles, right? I use these, So collaborate sessions, including collaborate sessions, is going to be 90 hours per semester, right? We're practically, having 90 hours. So, without further ado, let me first take care of this, because, one, somehow part 5 is missing. I don't know why. Here it is. I'm going to have to. Oh, no. Why is it not giving me copy? All right. 1101. Yeah, I'm sure. I'm sharing my screen now. So. No. Okay. So it should be there now. Oh, it's not showing. Why? Something's not. Um, oh, by the way, I mean, without this is something I do just to copy a link that was missing. So you don't need to get. I mean, it won't take much time, but you don't need to get. Um, you don't need to get bogged down by it. 1101. Why? Oh, that's spring. Okay. Um, so if you go into this folder, you will find, these are just files, right? And then down here, these are videos, right? These are video links. I believe I'm still in student mode. That's why it is giving me this. So let's go back to. And it also clearly says, please download the above files to use them with the video. So you must download these two files. This one, um, it's an option. I mean, you can download it, but it's a graph, data and graph. So you will need it later on, but for now, you need to download these two files. So everyone downloaded these two files. Hmm? It doesn't take that much time to download them, right? So here, okay, here. Today, yeah. And if you have already watched these two videos in the since last Thursday, you're quite ready for the discussion today. The rest of them you can watch later. Um, so let me. I have already downloaded it, and so I'm gonna just start with the first concept we must start with. So our first topic is return on investment. Okay, and return on investment is probably the single most concept in investing. Okay, I said single most concept in investing, not necessarily in finance, because in finance, um, return on investment, uh, yeah, in general in finance, you can say return on investment is also um, overall, investing is part of, finance. So, um, but if it is the single most concept in an area of finance, then it may not be the same for the a greater, bigger category. But it's not so in this case. It's also the single most concept in the entire branch of entire discipline of finance. Why? Because if you think about it, finance is all about uh, investing is all about maximizing the return on investment, but also if you think about it, finance is all about uh, closely aligned with that concept. Finance is also closely aligned with the concept of maximizing return on investment. I mean, microeconomics is all about profit maximization, right? Um, then it's not that different for finance as well. It's about return maximization. Um, of course, I don't want to go into I don't want to go too deep and too broad, but the whole if you are interested in investing, it's all because of the return on investment, right? If you're interested in stocks or bonds or any financial instrument, why? It's because you want to get it's because you want to get maximum return, right? But the maximum return is it's hard to define where it is. It's hard to draw the line. What is the maximum? Is maximum always, I hear this thing. Somebody is, typing into the chat box, but please say it, because when I'm looking at this, file, and while I'm looking at this file, that's what you are looking at, and that's what I'm looking at too, right? I have to switch to the Blackboard to check what you are typing in there. Oh, group chat. So, alrighty then. I thought you had a question. Where was I? So, now think about it. Return on investment is rate. It must be expressed in percentage. It's a rate of return, right? It's a rate of return. Now, let me take let me use an example. First of all, let's say you bought a stock, right, for $100. Okay, just one share of stock, for $100. I mean, if you bought 10 of them, that would be $1,000, of course. But it's just whether you buy one share or 10 shares or 100 shares, you can just scale up or scale down by zeros, so it's not a big deal. So just for simplicity, for the sake of our thought experiment, just assume one share, because in reality, in reality, it's not likely that you can buy only one share, right? It's not impossible, but what I'm saying is, that's not realistic. But anyway, let's say you bought a stock for $100, and a year later, the price was $150. You sold it. So you sold it. Then, it's clear you made $50. Isn't that right? You made $50. And then some people just easily say, some people are just quick to say, oh, I had $50 return, or I made my return was $50. But actually, if you think about it, that's not the correct way of saying that. In spoken language, you may say that because it's spoken language. I mean, it's a colloquialism, right? Colloquially, you can say, I had $50 return. My return was $50. But actually, the correct way to say that is, I made gain of $50, or I gained $50, or I made capital gain. I made capital gain of $50. Okay, capital gain. So what it means, so either that $50, you can, some people call it profit. Yeah, you can call it profit, right? Or you can call it capital gains. You can call it profit, or you can call it proceeds. Okay. But if you use the term return, it has to be in percentage. Return, because return means rate of return. Rate of return. I mean, in spoken language, nobody will put you in jail for saying I made $50 return. Okay, and there's no, and it's not. It's not, it's not, grammatically wrong, or there's nothing wrong with saying, but it's just a distinction. When we say return, it conventionally it means a rate of return, right? So in this case, you can say I made 50% return, 50% return, right? It means rate of return was 50%, and return on investment was 50%. You don't say return on investment was $50. You understand? Okay. So let's make it very clear. When we say return, it means percentage. It means rate of return. Okay. So return on investment is, in a way, it's like an interest rate, right? Because if you put $100 in a bank, and if the bank interest rate is 50%, of course that's not realistic. That's totally in a fictional world, maybe. Oh, of course, we are doing a thought experiment, so it's a fiction, right? If the interest rate is 50%, a year later you will have $150 in your account, right? So basically, return on investment, interest rate is return on your money, isn't it right? If you put it in the bank. If you generalize that concept, right? Instead of putting that $100 in the bank, if you put it in, financial instruments like stocks and bonds, or even, real estate, right? And of course, it's unrealistic that you can put $100 in real estate. But anyway, if it is, hypothetically, if it is possible, right? If you put $100 in any, investment instrument, and if a year later you got, 50% return, that's the return on your money, right? And return on investment, right? So how do we? I called it two types of return, but they are basically the same thing, and it's not like it's not differently. I only called it two types because one is standardized, and the other one is not standardized. But standardized in terms of what? In terms of time frame. In terms of time frame. Now, holding period return is the return in with the non-standardized time frame, because holding period means holding period of the asset. right? Okay, so um, you can, for example, you can hold the stock for 2 years or 10 years. You bought uh, uh, stock of company X, and let's say that was $100 when you bought it. Maybe you bought 10 of them or 100 100 shares. Uh, then that's 100 times 100, so that's 10,000, right? Um, and a year later, and let's say you hold it for 10 years. You can hold it for 10 years. You can hold it for just 1 year. You can hold it for 5 years, or you can hold it for even 3 months. I mean, depending on when you feel like selling them, right? Your holding period is, your holding period ends when you sell them, isn't it right? So, holding period, the holding period can be anything. It can be even 1 day. It can be even, 3 minutes, right? It can even be 10 seconds, uh, because in case of day traders, and you know what day trader is, right? Day trader is someone who holds the uh, financial assets such as stocks, and usually, it would be stocks only, because bonds, nobody holds bonds just for 10 seconds. Um, anyway, day traders are the short-term traders who just buy and sell very frequently. They don't even hold it for 10 minutes. I mean, they do, even during the same day, they can buy and sell multiple times. Of course, it doesn't have to be the same stock. They can buy stock X, and if the price movement is, if there's a price movement of, even 5%, and that's a big 5% price movement is a big thing. I mean, um, still, some stocks move very um, like crazy, very wildly during um, even a single day. Some stocks generally move uh, more mildly, during the day's trading. And I would like to show you one example. Let's say this is Apple, and Apple has, behaved very well. I mean, well doesn't mean, um, relatively, Apple had, smaller variance in the range of its price movement. So this was, hourly. This was as of yesterday. If I let me refresh it, and so look at this hourly movement, right? And these are, in hourly movements. But yesterday was August 30th, right? You see, 9:30 a.m. the market opens, 3:30 p.m. the market closes, right? And then at 9:30 a.m. made a um, it made a jump. It looks like it was a uh, huge jump, but think about it. It opened at 149, right? In that box to your left, right? In the upper left of the screen, you see it opened at 149. The highest it reached during, the day was 151. The lowest was, but it closed, and then it closed at 330. That was close, right? Close price. And then when it opened at that's five. At 5 p.m. there was no trading. After 3:30, it's actually after hour trading. It's called after hour. The market's closed, but after hours, the trading happens outside the stock exchange, only over the system. So and today when it opened, right? See, there is constant movement, even at 6, 7. But the market opens actually only at 9:30, because I'm showing you the price trend, only by hours. But if I show it by days, you will see that you will have only uh, uh, 9:30. 9:30. The market opened 9:30 and 3:30. Market opened at 152. Now, but if you think about yesterday when it opened at 9:30, it opened at 149, but when it closed, on the 27th, because 27th was the last trading. 27th was Friday, and that was the last trading of last week. And there was after-hour trading, but while the market was open at 3:30, closing price was 148, 148.60. Remember what was the opening price on the 30th, Monday? It was 149, right? Remember that? So although it's just optical illusion. If you think about it, it's just an optical illusion. It opened at 149. It's only because the graph is only capturing a small timeline, short timeline, because and then is showing the data by hours, right? Hourly data. This was only when the beginning of this graph was August 11th. So only about 2 weeks time frame, and everything is by hours. So the range of movement, price movement wasn't that wild. The range of price movement was only barely like look, the lowest point was 145, highest point 153. So that's already you might say that's already quite decent variance. Look, compared to the historical average, this is not such a wide variance, because if I last 5 years, let's take a look at last 5 years and monthly, right? Let's take a look at the monthly data, right? Last 5 years. Look, the price movement was generally attenuated until up to when? Up to around, this was like 2018, right? And even about 2019, the price movement was relatively in a moderate, right? Had moderate variance. But then starting from like when September of 2019, and then the price movement had a wide variance, very wide variance, right? Started, but of course, this is, if you're looking at it only now, it may look like that, but throughout the entire life of Apple, actually there were multiple points where the price variance in the price movement was rather dramatic. But here you see, what are all those D's and S's? D's are the time when they paid out dividends, right? Dividends. And then S is when they had split, right? So August last year, they had 4-to-1 split. And then this was like 2016. Oh, 2014, June, they had 7-to-1 split. So split means a stock, one share splits into multiple shares. 1-to-4 split means one share splits into 4 shares. So if the stock was $100, if the stock is $400, then it splits into 4. So each share is now $100. But your holding, the value of your holding, is still 400 because you have 4 of them, right? You have 4 shares. Previously you had only 1 share. Now you have 4 shares. So the total value of your holdings is still the same. Okay. And whenever they have the split, right, the pre-split prices, so think about it, when the price was 400 and they had a split, then the price will fall to $100. And think about it, it will look like you must make an adjustment to the pre-split price, right, so that it will be the data should have continuity, right? Do you understand? Think about it. If before the split, right, if they had 4-to-1 split here, and then let's say on the day of the split, the price was 129. The close price was 129, right? That means, after the split, the price was 129. That means before the split, then the price was like what? It must have been at least, $480 or almost $500. Isn't that right? Does it make sense? I mean, after it's split into 4, and after split, if the price is 120, then it has to be 480 at least, right? Before split, pre-split, right? But then think about it. Will the graph look like this? Will the graph look like this if prior to the split the price was 400 and after split price is 120? Will the graph look like this? The graph will look like this. If you leave it like that, the graph will look like this, that the prior to pre-split price would be somewhere here. You understand? It will be somewhere here because it's almost close to $500. And then suddenly it will drop to 120. Look, it looks like, if you're a total stranger and you had no idea that there was a split, then just looking at the data, you will think that this stock, Apple, crashed on that day, right? Looks like the Apple's price just lost 75% of the value, and it crashed, right? But obviously, we know because we know there was a split, and I told you there was a split, and this is understandable. After split, if the price is 129 after split, and if the graph looks like this, then they prorated, right? They made adjustment to pre-split data so that the data trend won't have any shift or crash. In other words, so that the data trend will have continuity, right? The data trend will have continuity. So they prorated. Okay. It wasn't my intention, but I digress too much. I mean, originally, the only reason it wasn't about, it wasn't to talk about the splits, but and the data continuity. But the reason I brought you to this point was because I was trying to explain the wide there can be wide variance in the price movement, and the recent movement in the price in Apple wasn't that crazy, right? Although if you are looking at a shorter time frame, and with more frequent data interval, right? With more frequent data interval, like 1 hour, hourly data, hourly price, then it looks like the variance was wide, as if it was very volatile. I'm not saying it wasn't volatile, but is relatively the variance was relatively moderate compared to Apple's historical data. And you can also tell because here there was 7-to-1 split. Wow. Then and it looks like it was after 7-to-1 split, it looks like it's $23. No, actually this is adjustment after adjustment, because at the time when Apple had that 7-to-1 split back in 2014, the price was almost about pre-split price was almost about $700. I mean, it was close to 700. It was like 680 or 680 or something. And then they have 7-to-1 split, and after split, then the after split price was like a 90, 89 or 90. Okay, I don't know if there's anybody who remembers and 2014, most of you were probably like not even a teenager. So some of you, if you were an adult at the time, and if you were interested in stock, if you're interested in stocks, maybe you may remember, but most of you were probably not even a teenager at the time. But think about it. If they had 7-to-1 split, I remember this because I've been Apple shareholder, and I was holding 10 shares of Apple at the time. But prior to the split, I sold, and only last year I bought them again. I believe I bought them back, after the split. Of course, this time I bought more than 10 shares, but I just tentatively, I bought 10 shares, in 2012, 10 shares, and right before the 2014 split, I sold just to realize the that return. I made 10% return, but I had to sell them to realize that, right? Think about it. If you don't sell, it's only paper gain. It's only in paper, right? So I just wanted to make that realize the return. I shouldn't have sold it. I should have kept it there. But just to it was just 10 shares, and I wasn't I wasn't very serious about holding Apple, for a long term. Just wanted to try out and realize the 10% return. But anyway, think about it. So it was about 680 before split, and after split it was about 89, 90, and then that got adjusted again. That got prorated again after. So in other words, that $89 per share grew to like back to like $500, right? So that was between 2014 and 2020. It took 6 years, and in 6 years it grew from like $90 to 500. That's more than 400%, right? That's more than 300% return, right? Because from that's more than 400% return from $90 to 500, more than 400% return. So when they split 4-to-1, it's almost like getting back to about $100 range, right? And when they split here from 680 to a 7-to-1, they were trying to keep it at around $100 range. You might wonder why they want to why do they do that? You might wonder, why do they do that? Why don't they let the price continue to rise? Well, if it's actually I'm gonna it's gonna be another long discussion about that, but they want to keep the price. Let me cut to the chase. They want to keep the price in a marketable range, right? Marketable. If they let Apple keep going, the price. Apple actually grew almost currently it's 152. So since the beginning of Apple started no, what did I do? Does anyone know when Apple started out? Anyone? Are you there?
1976 of April is when it was founded.
Yeah. But and who was that? Who gave me that information?
My name is Noel.
Noel, okay. Okay, I'll give you 0.25 point for that. But when did it go public? In other words, when did it start to sell stocks? When did their stocks? When did they start to get listed in the stock exchange? And when did they first sell their stocks to the public? So, in other words, when was their IPO? When did they go first? When did they first go public? Does anyone remember? Does anyone know that?
Was it
December 12th, 1980?
Oh, someone said this. Who said this? 1980. Who said?
Me, December 12th, 1980.
December 12th, 1980. Yes, let's say 1981, because December 12th is almost, that means there was no trading in 1980, but obviously because it went public in 81. So in other words, the history of Apple started in 1981. I mean, as far as the stocks are concerned, Apple stocks are concerned. Now, do you know what was its IPO price when it was first started to sell? It was about $10. Its IPO price, the par value, was $10. But now think about it. Over 40 years, it's now 152. So that means that didn't seem a lot. That doesn't seem. And who gave me that information? Who gave me that 1980?
Me, Naomi Bruno.
Okay, Naomi. All right, Naomi, you got 0.25 for that. Now, so you might think, it didn't grow that much. No, actually, think about it. The calculator, what did I calculate here? What did I put here? What I put there? Oh, maybe did I do that? Yeah. Actually, this is Apple grew 1,559 times, right? Without think about it. Apple had multiple splits over the last 40-year time frame. Multiple splits. So if after adjusting for split, if we didn't adjust the prices for split, then starting from $10, it should be now $15,100, right? $15,100. It should be that should be. How do I know that? Because if I was just in 81. I was a college sophomore, junior. I was that was my a sophomore year, and then going into junior. And had I money, if I had like $10,000, even $1,000 at the time, and had I known the company Apple at the time, I would have been 1,500 times better off now, right? Think about it. 1,500 times $1,000. If I had $1,000, right? I would be 1.5 million by now. Isn't it right? 1.5 million. Of course, if I put in, look, if I look into the maximum, right, and then annual, it starts from annual. So all the way back here, that's like 1981. Of course, I can just, get the data, but, graph is very drastic. So to keep it there. Let's say it's hard to keep it right there. So somewhere here, and this was, this is December of 1981, and the close price was 14 cents. Now, again, this isn't really 14 cents. You gotta keep in mind that after making adjustment for splits, multiple splits, there were splits here, split here, and because everything is condensed, right? 40-year time frame is condensed. We don't see that split. More recent splits yet, but this was split back in 1999, split in 2004, Now think about it. At least the splits that I know of Apple, 4 or 5 times at least. And uh, and if I remember correctly, after making that, after proration, making adjustment for all those splits, and the 81 in 81 it was like $10. And then if you look at it like this, it looks like almost as if there was no price movement at all for a very long time. No, there was, of course. It's only because after making adjustment, and then since we are on a scale of 0 to 152, the price movement within like a few dollars range would be almost immaterial. That's why the graph would look like this. But you got to take into consideration that it's because of the adjustments for all those splits. And you can also tell, oh, they were paying dividends, during these years. But there was a long gap. They didn't pay dividends, almost, a decade. Starting from like 1995 all the way to like 2010, almost 15 years. They skipped dividends. And usually, a company that has to plow back everything into the company for growth, would not pay dividends. And Apple was heavily reinvesting, right, in their growth during these years. So anyway, just to it's already 12:11, so I think we are well past the time, and I digressed a bit too much from the main focus, but main topic. But that's why this collaborate session is not the main lecture, but this is more like an afterglow, or like a reception. If you are at some social event, more formal social event, you will have there's speech, some dignitaries. There will be a speech by some dignitaries, right? Some important people, and the speech is normal, and it's and then some, formal session, and then after that there's reception where you have some cocktail, and you have some snacks, and have some chat around the main topic of that day's event, right? Or it could be something non-related to the day's topic, but generally people would continue on with the issues around the day's topic. So you can consider our collaborate session like the reception after the formal event. Okay, the formal event is the main lecture delivered through the pre-recorded videos, and collaborate session is like an afterglow. That's why I said it's like an afterglow, where we reflect on the. So this way we can have more rich conversation. We can have more rich conversation than just what 3 hours per week can deliver, right? And 3 hours per week, the designated, the scheduled class time. During that time, it has to be the formal main lecture, which is the formal event. Okay, so let's. I want to take. Let's take a 10-minute break. It's 12:14 now, so we'll be back at 12:24 exact, 24:25. And because we digressed a bit too much, then we'll wrap it up here. And when we come back from the break, then we'll talk more about the main topic. Okay. Alrighty. So let me just stop sharing and let's reconvene at between different investors, right? It's non-standardized, right? We need to standardize it, right? Holding period, so the standardized, time frame of the return is annual, right? So it's if I had an asset, if I was holding a stock for 15 years, or it doesn't have to be like 15 years. It could be 9 years, 3 months, or just 7 months, or even days. Even 60 days, or even 45 days. You can annualize it. You can annualize it, right? I mean, um, some people call it annual return, but it's different. Annual return and annualized return are slightly different. Why? Annual means literally you have annual data, right? If you have annual price data, you can, calculate return. Annualized means, whatever is non-standardized, you standardize it. Whatever is non-annual, you annualize. Think about it. If you were holding stock for only 75 days and you sold it, and obviously there are some returns. So over 75 days, you made, let's say 10% return. But if you annualize it, how much would that be? Right? Of course, you can, you can take the ratio between 75 days and 365 days, 365 days, and you can basically scale it up, or scale it down, or scale it up. But the point is, annual means the data is already put out as annual. In annual, they measured the data, they collected the data at each annual point, year-end point, and that's annual. It's already served to you in a silver platter as annual data. But annualized data means the data originally didn't exist as annual, but you annualized it. It took annual average in a way, right? So that's annualized. Now think about it. So you had, you were holding stock X for, you were holding stock X for 6 months, and you made, a 10% return for 6 months. On the other hand, your friend was holding stock Y for 5 years, right? And he had, a 50% return, right? The holding periods are different. You had only 6-month holding period. The other guy, your friend, had 5-year holding period, right? And because his holding period is much longer, and it doesn't always guarantee that, but if you generally hold it longer, your return would be higher. And clearly his return is higher. But then his return was 50%, but your return was 10%. I mean, if you just look at, obviously, this is not the fair comparison, because it's not like, this is like, apples versus oranges, right? Because he was holding that stock for 5 years, and you had it for only 6 months. So we must, basically standardize them. And you can already tell why this is important, because you had it for only 6 months, and you had 10% return. So if you If you held it for 1 year, it could have been 20% return. Of course, there's no guarantee because it never happened, right? But you're not basing it. You shouldn't base it only. I mean, to annualize it, you shouldn't base it only on that 6 months. I mean, you have to look at the past data, right? Past 5 years data, and then including the 6 months that you held it, right? Past 5 years, and you can annualize, and then compare that with and you say because he had it for 5 years and he got 50% return, so it must have been 10% annually. Well, that's a very simple thinking. I wouldn't say. I mean, the logic is, the rationale is good, but then it's not really 10%. If you annualize it, then considering the compounding effect, it would come to something less than 10%. It should be something like it should be something less than 10%, and still gets the same result. But anyway, this is the reason you need annualized return, because every investment, every investor, and every investment instrument and the holding periods are different, right? Depending on the investor. And so let's take a look at this formula. First of all, there are subscripts, and those subscripts, are called time subscript. It simply means, this is the price at time so time t is always now, okay? And if this is annual data, price data, then time t plus n means any number, right? It's a random number. N is a random number. So if time t is now, t plus n is n years later, right? Makes sense? N years later. So let's say n is 10. So price now is $100. Okay? And 10 years later, p sub t plus 10, price 10 years later, is $200. And simply, we can tell what the return is. I mean, ignore this part for now. The price appreciation or capital gains is 100, right? 200 minus 100, and you have to divide it by your initial investment, right? Because it's the percentage that captures the growth, right? From your initial $100, how much did it grow? It grew 100 by $100. So 100 over 100, the ratio is 1. That's 100% growth, 100%. But if this is a stock, there will be additional cash flows. Additional cash flows for, in case of stock, will be what? Dividends, right? So this means summation, right? Sum, where time starts from 0 to n. Time runs from 0 through n. So if t is 0, current, now, price at time 0 is what? You think that's this year's price. If it is annual price, this year's price. But what if this year isn't over yet? We are in the middle of, we are at the end of August. We still have 4 months. We still have 4 months till the end of this year. So we don't have the end of the year price data yet. Okay? And then what? The most recent price data that we have is the price at the end of last year. That's P0. You understand? That's P0. P1 will be the price at the end of the first year, right? So P1 will be available only at the end of this year. But until then we have only P0. That is the most recent price. So that's the P0. That's the current price data we have. And again, in terms of annual data, right, or in terms of any data, think about it. End of last year is the same thing as what? End of last year is the same thing as what? Anyone? Can anyone answer this? End of last year is the same thing as what? This isn't too hard. I mean, this is something you know already, and it's something you just need to. You never thought about it, analytically. Does anyone have any idea? Come on. This is the logical reasoning, and end of last year is the same thing as the beginning of this year, isn't it right? Anyone? Think about it. End of last year is like what? December 31st, 2020, 11:59, and then 12 midnight. I mean, the clock is ticking from 11:59 to 12 midnight. But what is 12 midnight, December 31st? Isn't that the January 1st? Yeah, 0 hour, 0 hour. The exact beginning of the January 1st, isn't it right? 12 midnight is 0 hour January 1st of 2021. So if the price data was collected at December 31st, at the end of the transaction, trading at the last transaction on that day, right? Isn't that the same thing as at the beginning of? Is that the base data? Is the data that we start with at the beginning of January 1st, 2021? It's the same thing basically, right? Of course, if there is after-hour trading or after-hour transaction, because opening price would be slightly different from that, because that's what the price is starting at. But then, because of bidding as the market opens, right, on January 1st, the price would slightly move from the end price, the close price of December 31st. But anyway, the point is, but that's the base point, that's the baseline we are beginning this year with. So PT is, if that is the this year, it will be P0 at the beginning of price at the beginning of this year, which is price at the end of the last year, and the PT plus N. That's in the future. I mean, 10 years into the future, we don't know what the price would be 10 years into the future. But let's say then we can move the time. We can move the timeline 10 years back. Let's say this was price 10 years ago. Then this won't be 0. This will be P negative 10. P negative 10, right? That's like 10 years back. And then this will be P0, right? Makes sense? So that's the capital gains over the holding period. And this is the additional income, additional cash flow during the holding period. But in case of stock, it will be dividend. But once again, dividend is not an obligation. you saw that Apple didn't pay dividends between 1995 and 2010, right? For 15 years, Apple didn't pay any dividend. So dividend is not an obligation. If it is a bond, it's the interest that the bond pays, right, during that holding period. So that's the concept of holding period return. Okay, so we're out of time. It's 12:40, and somebody left. Jonathan Andrew. Yes, Jonathan. I don't know what you said yes to, but I believe beginning of this year, end of last year, right? All right. The time is up, so I will have to stop recording and close it out. So take care, everyone, and stay safe, and see you guys all on Thursday.
Bye,
All right.
Have a good day.
All right. You too, Angelica. Take care, everyone. Yeah, Carolis. Take care.
Have a
Let
good
me close out. You too, Noel. All right.